Okay, welcome to Members eLearning on the 6th of March 2019. And we're going to get going. Yeah, you got them up. Good, Rick Stir. Thank you very much. I appreciate that. We're going to go over the charts and patterns, the setups of my charts, and then the patterns that I like to use. And then we'll go to some live charts. And one gentleman asked me to, he said he was just opened up and joined the room and was overwhelmed by what he was seeing on the screen. So what I'm going to do at the tail end, I'm going to ad-lib what you see on the screens themselves. So this is going to be akin to the guy who was out in the desert for 30 days, finally found the oasis, and he says, water, water. They bring a fire hose and put it in his mouth. It comes out of every opening in his face. All right, we're going to go chart types. Then we're going to talk about some of the different types of candlesticks there are, and the ones I use and why, and the pros and cons of each. Then my chart settings, and then the high probability patterns. Chart types. The number one thing that we really need to think about is keep your chart clean. Look and consider what the value is of any indicator before you put it on, because if you put on too much stuff, two things will happen. You'll get paralysis by analysis. You'll be overwhelmed, and what will happen is that one item won't line up and you'll wait for everything to line up. Well, that probably occurs once a year, if that. So therefore, it's about probabilities. If you've got 4 or 5 of them that are lining up properly, you may want to give it a shot. All right, and the other thing is, I've run into one gentleman that is a dear friend of mine out of Canada, not in our room, but I met him some in golfing and stuff like that, and he is always tinkering with indicators. I'm always looking to see if I can improve it, but basically I'm pretty much kind of frozen in time. But if I've already got an indicator that works and it works well for me, if it ain't broke, don't fix it. You know, and I don't try to put in duplicate indicators. This gentleman has 5 different oscillators that he has, and it's copulating worms on his chart. He can't see the primary focus of the chart, which is price, because he has way too much on the screen. I try to keep it pretty simple. I actually have moving averages on there and only just a couple of them in there, but I probably could do without them, and they're really training wheels, and I'm trying to train my eyeballs to see the trend and your eyeballs to see the trend. And it's the moving averages are really for the benefit of you guys instead of me. All right, choose your time frame. I got a little ahead of myself there. And you could use, and I say time frame in quotes, you could use time-based charts. You know, things like the 1, the 5, the 3-minute, 15-minute, daily, weekly charts, those kinds of things. Or you can do range-based charts, which are things like the tick, the range, and the Ringo. And Ringo and tick are 2 of my favorite range charts. And I've got a little bit of a description over here, the time versus, what they are. The time-based charts, they're easy to predict when they're going to close, which is okay. I'm not sure that when a candle closes is an important factor. I'd like to know at what price level it is and what signal it gives, probably more than anything else. And that's the problem, is that its con is it's hard to predict where they're going to close. And it says here that they can lag, leading to late entries. Well, if you try to make a 5-minute chart, let's just say we'll go over Abercrombie and Fitch a little later when we go live. If we had traded on, say, a 5-minute chart, would we have made any money this morning? I say not. We needed to go on some sort of price and range based chart and or a very much smaller time frame, like a 2 minute chart. And that's what I had. Is I had 1 minute chart up, and then I had the tick chart up as well. And so therefore, I was comparing those, and I jumped in. Oh, what did I do? I did jump in at 9:32:13, so it was right after 2 minutes, but it wasn't waiting for 5 minutes, because in 1 minute and 45 seconds I was out with $85 profit. So in my mind, if one had waited a little later for a 5 minute close or whatever, look at the chart, you either wouldn't have made necessarily as much, or you may not have made a profit at all. So you can't necessarily try to shoehorn it into some price, in my mind, into some arbitrary factor called time. All right. Range-based charts are based on the set price movement, regardless of how much time it takes. And then when the markets are going fast and furious, you can have multiple candles printing in a 1 minute time frame. And when the market's in snoozeville, you could have no price movement, and you could go for minutes having very few candles print themselves, like no trend. I'm looking at here, what is that? There's a chart that I've got. Halliburton on the side here has a chart that I was looking at, and it moved fast and furious this morning, and after about 12 o'clock, we've only had about 20 candles print total. So, basically it's showing you that it slowed down on the trading. They will react, the range charts will react faster to changing prices, and the key here is that it enables earlier entries and exit. You can see the change in trend. And they'll close, when they close, it's probably pretty impossible to accurately predict, but I don't really need to. All right, let's go to the next chart. The tick, volume, and range charts. Let's see. We talked about the time-based charts. Okay, a tick chart. You just basically set a number of ticks, number of trades that you want to happen before it closes that candle and starts drawing a new one. A lot of people will pick things like 377. They'll pick 512s. There'll be 1024s. I think I remember see somebody had a 1636. I have no idea where they came up with that one, but one of the ones that I used to use in the a lot in the futures market was 377 ticks, and it just happened to be a happy medium. You will have to play on a tick chart and a range chart. You'll probably have to play around with what settings you use that are best best for you to use for the instrument that you're trading. And the pros of that is it can help you judge the momentum, but the con is that all trades are created equal, and one trade at 1,000 shares or 50,000 shares are going to be those will be equal trades. And in fact, we know that these are probably not equal trades. Volume. I'm not a big fan on volume bars. I cannot get my head around the idea that a volume bar would be telling me anything that I would want to see other than momentum. Well, I have other ways to judge momentum. I can judge momentum by maybe a stochastics RSI, or I could judge it by using the R-squeeze or some other momentum oscillator that's dedicated to that purpose, or I could also just look at the rate of change that I'm getting these candles to print. So it's going to be pretty obvious to me if I'm getting a whole bunch of them printing one right after the other that I've got momentum going. And the volume, number of shares or contracts traded, I'm not sure that's going to tell me anything. I used to be a volume guy. I mean, I'm talking about 20 years ago, but I'm not a volume guy anymore. I've seen so many times where we'd either rally or sell off on very light volume. And I got fooled into thinking that, well, this is going to run out of steam, usually to the upside, that we rise on lower volume, and I just keep saying, it's going to turn around soon, it's going to turn around soon. And I basically passed up some really good opportunities. So I said, you know what? After banging my head against that wall for a couple of years, I said, maybe this isn't such a great idea. So I started looking at other things. Ranger Renko, and that's kind of what I've settled on for the moment anyway. It's based on price movement. The Pro, it helps visualize the trend and reduces the noise. Because if you get a lot of zigzag and ups, and if you had a large number of ticks, let's say each brick is 10 ticks wide, like 10 cents, the price has got to move a bunch before you can draw a new candle. Well, if those Range or Renko bars are spread apart far enough, it will eliminate all the jaggediness that you might have. And I'm gonna poke myself up right here in. See, I've only got a 3 tick here, 3 Renko, and you see how it goes up and down and up and down and up and down. This actually could be considered noise, because in fact the trend is down. It's not great down. It's from up here around 29.60 to as low as 29.35. That's not a super wide range, but I can visualize how this is bouncing along between the range here. Well, if I were to change time frame and go over here to 10 ticks, and now you can see how we have very steady. We've taken out a lot of the noise. All right, so now you're not going to get very many signals, and that doesn't work for day traders, but that might work for an intraday swing trader, or if you used them on much larger time frames, and instead of just looking at a today's ticks, you looked at range chart. You looked at a Range or Renko chart over multiple days. All right, it will help you reduce that noise. The problem is, and then this is a big problem with this, is that optimal brick size can vary from instrument to instrument and even day to day. When you're trading a small number of instruments like the futures, that works pretty well. It works extremely well because they tend to trade very similarly from one day to the next. But when you start to bounce from chart to chart, let's call it Halliburton or Abercrombie and Fitch or whatever, they'll vary widely. 10 ticks might work on one chart. Somebody that's reported, let's look here, we've got 10, we've got Hal. Let's go ahead and pop this up. Let's look at Abercrombie and Fitch earlier today. And that's the 10-tick chart. To go, whoa, these are not the same. That's correct. Somewhere between an 8 and a 10 works really well on stocks that are very active. And this was something like, 300 times normal or something like, or 36 times normal volume. Why? Earnings. And it has high short interest. A lot of people were covering. So the whole idea was that you're going to have to figure out what works for you for that instrument. And each has their pros and each has the con. In my mind, I want to visualize the trend and I want to reduce the noise, and I'll worry about the brick size and try to play with it, because I'm primarily trying to trade momentum stocks. All right, and then we're talking about a couple of different types of charts. Hold on a second. Excuse me. I do apologize. I am still fighting off a cold from a couple of weeks ago. I've got this tickle. Here's the tick chart on the left. And the tick chart goes from about 1027, I believe it was yesterday in the spiders, to about, 1038, 1033, something like that. Okay, that's what that hit. It only formed 8 bricks from the low here of a hammer up to the high at about 1032. So 4 minutes, 8 bricks. And that's on a 377 tick chart. My Renko chart, which was set at 3 ticks, 7 reversal, at 24 bricks. Is it going to be a lot easier to see the wig waggle here, know how we're doing versus the trend, know where this, whether we're getting a change in direction or whatever, using the Renko chart right here on the right or the one on the left? You'll have to decide what's best. It fits your trading style. Mine fits on the right. All right, my chart setups. We're going pretty fast. There are only about 11 or 12 charts here, and then we're going to go into the live charts. But we're smoking right along. Moving averages. I use them to help visualize the trend. I used an 11 exponential moving average and a 20 simple moving average. Now, I have also found that a 9 volume weighted moving average is an approximation of a good trend, but not all systems will allow you to plot out a volume weighted moving average. And if I took the spiders from the other day and put the 9 volume weighted moving average against the T3R7 settings, we would have dipped below that and probably stopped us out. In fact, in this case, the vol stop stopped us out at 1031 or so, although the moving average did, or at least the dominated vol stop would have taken you out if you had used it. And if you use the 11, which I've got here, you noticed a couple of things. You see the difference here once the faster moving average crosses above the slower moving average. This shows as blue, but in fact it's a kind of a blue-green. This shows that you're in an uptrend. Vice versa, if the faster moving average is below the slower moving average, you get this reddish tint to it. So this visually tells me I'm in an uptrend. What am I going to be looking for? I'm going to be looking for longs. I'm not going to try to do counter trend trades. Even if it starts to turn down here, I'm still going to let it run. I may get a sell signal, which is what we had here, but I'm not going to get permission to go short. What this does is I want the trend to be in my favor. I want to be having wind at my back. I want the tide to be coming with me. I'm not going to swim against it. I'm not going to be that salmon swimming upstream and dying, because I'm going to try to take the easy way. What happens, what is a rising tide floats all boats? It'll also cover up some of my mistakes. If I either get in too late or I made a poor entry. That trend will help cover up a lot and make me look smarter than I really am, which wouldn't take a lot, I guess. R squeeze oscillator, and that's here at the bottom, and I use it to judge momentum. You can get it either R squeeze or the TTM squeeze and Thinkorswim and NinjaTrader. They're available. If anybody wants me to help them set those up, just let me know. We can set up a session about an hour or so per trader and go over your chart setups and talk about them in particular, and I'll help you if you want. Stochastics RSI. I love the Stochastics RSI on Thinkorswim. I used to use Stochastics RSI in NinjaTrader until I went over to NinjaTrader 8. NinjaTrader 8 has it built into their system, and they broke it. They didn't have it before. They implemented it. They implemented it, in my case, in my opinion, incorrectly. And the person who did it as a third party said, well, they already have it, so I don't need to do it. I'm trying to convince the gentleman that he really does need to program it because it's not working right. So what I do is I have the toss charts on the side and kind of watch the stochastics RSI on the side as well. Okay. If you want to read more about the R squeeze, go to this URL. It will really talk to you more about the gentleman who, I guess, popularized it. I'm not going to say that he actually invented this because I know that he didn't. But John Carter, the TTM squeeze, trade the method, available for free, already pre-licensed stuff. A lot of it stuff I like. Some of it I don't necessarily. And the squeeze indicator is a decent momentum indicator, and you read more about it there. Swing levels, because I have NinjaTrader, and because I can also do it in Thinkorswim, I'll have the computer automatically draw swing levels and which I use as support and resistance levels on my chart. And you see this is one you can see from NinjaTrader, and you can see automatically drawn ones. This was a manual price level that I've drawn, and then you'll see automatically drawn 5-minute opening range. You'll see the highs and lows here on the ones and the twos. They're basically showing you where the swing levels are. And if the swing level isn't broken for quite some time, it'll draw it off to the right. And those are important for breakouts, for targets, for exits, type of stuff. Stops, you name it. And we'll talk a little bit more about that. But it helps establish that support and resistance level, which I use as price targets or stops. Now the volatility stop, there's a little more about it right in here. And I'm not sure whether that's Doug's. We could dig up a little bit. Doug had a very good YouTube presentation on how he set up the volatility stop on daily charts. You could apply that to whatever time frame you want to use. You may have to adjust the the parameters. Right now I use a 10 period 1.5 standard deviation, and that does seem to work in just about any time frame that I use, from tick charts 5 minutes up to 15-minute charts and dailies. Let's go into the patterns that I like. And I've got my own name. Some people call this a J-hook, but I think it's more descriptive to call it a zigzag pattern. What it does a move up, it does a pull back, and then it does another move up. So it basically zigs and zags. And these zigs and zags start with a strong move, in this case up, followed by a pullback or a bounce. And so in this case, up, followed by the pullback. Pullbacks usually occur to some prior swing levels, and then they move up, and then you'll get a breakout over a prior swing level, which would be resistance, and you could either go long on the reversal with the stop down here, or you can go long on the breakout with the stop somewhere below that. The big thing about the zigzag pattern is the market has proven which way it wants to go. And you can enter on that reversal at the bottom with a stop under the swing low or near it. With the initial target is the prior swing high. And an ultimate move could be something like a measured move. Well, what's a measured move? Well, if this last move was, let's say, 75 cents, well, then from the bottom here, and I'd expect this one to be at least 75 cents to $1. So if you use a one-to-one measured move, you measure this move here, take the other one down at the bottom, and let's take it right here. If this one was 75 cents here, I go down to the bottom here and then measure up 75 cents, and that would be the target. And then I usually figure that it's probably going to overshoot it just a fraction. So I use somewhere in the neighborhood of 1.3, 1.2 to 1.5. It's basically a Fibonacci expansion. 1.3 something. All right. And these pullbacks where the zigzag the bottom, that's really best if it's at or near a swing level, because that shows really strong support. This would kind of pull back deeper than one would ideally want, and it broke through the swing level. So it broke through what? Well, these are probably the bots trying to suck people into going short, and then they're ripping their lips off. Sorry, I'm trying to swig some ice into my throat and help there so I won't cough on you again. All right, let's go on to the next one, the pop out of the box. Now, each of these has a pro and a con, a bullish and a bearish case. I'm focusing primarily on the bullish case, but the opposite would happen if you wanted to talk about the downside. The first thing you look for in the pop out of the box is you want some sort of well-defined top and bottom, some range. And it's got to be range vertically and range over time horizontally. And you watch for some sort of breakout with good momentum, maybe with the R squeeze rising, maybe from the zero line or below, like it did here. And and you place your stop because you're playing the breakout. I say you can't use all the way down here under the bottom of the box. To me, that's way too far back. Because if it comes back in here, and let's draw this up here. If I get the breakout and I bought the breakout, and do I need to let it come all the way back down to this level here of 279.30 to be proven that it's not what I want to be in, it's not doing what I expected? No. It comes down probably below where I bought it after going higher. Sunshine, this is not working. It's supposed to continue going higher. Step aside with low commissions. If it continues to go higher again, or maybe it comes back and retests the breakout area, fine, you can go long again. But the whole idea is don't just sit in there going, oh my gosh, it's not working. Well, then get out. All right, and I'm going to place a stop. Here's the average true range, the volatility stop. And if we bought up here, we're not taking it all the way down here. We're probably taking 279.36 as a stop. Then we're moving it up ever so slowly as we got the market going higher. Eventually, we're going to be playing with house money. This is an excellent video on the Poot B. I'd strongly suggest that everybody look at that. I mean, it's absolutely fantastic. He's probably forgotten more about a pop out of the box than I'll ever know. So I just try to learn the basics and implement the basics. KISS principle. Keep it simple because I'm stupid. All right. I think the last one I like to talk about is a continuation pattern. It happens extremely frequently. It's hard to judge, and they do have a tendency to possibly have a lot of fake outs here. Fake out breakouts. But when it does work, it is extremely profitable. What happens is you'll have some sort of movement, like in this case off here to the left, where you had a fairly strong move higher. You've now gone from a downtrend to an uptrend. And you can also see how my candles are color-coded. In dark green, that means that the fast moving average is above the slow. So it corresponds here. So dark green is really bullish. Green is possibly a little bit bullish. Little bit of orange is slightly bearish, and red is really bearish. Okay, but right in here, what you get to move up. You have a 2 to 3 candles. I say 2 to 3, 2 to 4, but it has to be at least 3 here, and then you have the move up, a continuation. And I call it a continuation because this move, it comes in, it tries to figure out whether it wants to go higher. It resolves to the upside, and the next move is probably going to also be a measured move. That this move from the bottom of that range on the continuation pattern itself will probably match for the body here to the top of that continuation pattern. So if this was $1 from the bottom here, you add $1, and then that's a pretty good target. Now, what I do is I look at that target, and I look to the left and see if there's a swing level or something, some sort of price level that it's been to before that it might want to use as resistance. So let's see if that That's there, and that would only reinforce the idea of the measured move. And we use the vol stop similar to what we did in the pop out of the box. And you notice right in here, the movement up on the volatility stop, and then when you did the continuation pattern, we had, oh, that's a little on the thin side. Okay, let's draw this. All right. Notice how those dots basically flatten out. That gives me a great idea that as soon as this moves, that right there is a really tight stop, and we're going to start moving higher immediately. And that makes me feel good because then I can start moving to a positive break even, butter break even. Many times, okay, what you have to see here, I forget it, I'm sorry, I jumped ahead, that the tops and the bottoms are essentially equal to one another. So let's do it here. And you see here the bottoms are about equal to one another and the tops are about equal to one another. So the real range of this continuation pattern is the outer box. Let me draw that again. There to there. And don't include this one over to the left. That is the continuation box. And usually, 90% of the time, when it enters here from the left, it exits in the same direction. That's why it's called a continuation pattern. I love it when these occur at a prior swing level, which is what I would expect. And if you notice right in here, on this example, there was a swing level. And where did it occur? Plus and minus a bit of that. And why does that occur like that? Because the bulls and the bears are trying to figure out whether they're going to let it go higher. Because you've got sellers pushing price down, you got the bulls trying to push it up to go higher. So eventually, who wins out? Well, in this case, it's the bulls. And a lot of the times, if you've got the momentums pointing towards you, the moving averages pointing up, the trends pointing up, you'll break out in that direction. All right, we're going to go over some live Thinkorswim and Ninja charts. We're going to do some time-based charts, some Rinkos on both of them, and I'm going to show you what we got going on here. Okay. Let's start with, where did I put that? Oh, good Lord. Nope. I've got to find it. I'll do this. All right, here's Abercrombie and Fitch on a 5-minute chart. And here's Abercrombie and Fitch on a 10-unit Renko chart. Both of them go from the beginning of the day. Let me actually take this puppy over here and take it to the open. All right, on the time-based chart, you had a movement, move up, pull back, and then a continuation move, grind higher. And it went up quite a bit higher than what we traded. We traded this first bit here. Could we have traded more? It's possible. But if you look at the exact same time frame, out of the box, you had a big, huge movement up to 25, 25, 20. That corresponds with the first two 5-minute candles. If you had used a 5-minute opening range and went long above the 5-minute, you could have gotten as high as 25.40, but you went also as low as 24.60 on the way back. Well, you went as high up here to 25.20. You pulled back to 24.60. We had 24.60 based upon the daily chart as an area that we were going to watch. And in fact, it held as support and then went higher. On a 5-minute chart, some people will say, well, gosh, can I go long over here with this high wave doji here and go long here with a stop? Well, possibly. Let's go look at what happens at 9 minutes and 50 seconds into, or sorry, yeah, at 9:50, 9 hours and 50 minutes into the day. Well, this is not giving me a warm fuzzy that we've actually have a nice tradable bounce here. The bounce over here at 9:36 looked much more promising than the one here at 9:50. Okay, so 9:45, 9:50, and the breakout occurs here about $25.41. And where does the breakout occur over here in the Renko? $25.40. When you see this one over here to the left and it kind of goes wobble, wobble, wobble for what? From 10:05 to 10:25? What happens over here to the left on the Renko? It goes up, it goes down, and it really doesn't really start breaking out till 10:25. Wait a minute. This one over here to the left is showing basically the same price movement as I'm seeing over here on the right. Which one do you think would be easier to stay with? The one that's kind of going back and forth and back and forth? Because remember, at one point, each of these two candles that ended up closing near 25.50 were actually full red down at 25.30. Were they full red down at 25.30 over here? No, they weren't. Not on the 10 Renko chart. It probably gave us a lot more confidence to stay with the trade by using the Renko chart. That's just my take on things of how the Renko is easier to judge what the trend is and where the stock is possibly going. Okay. Now, let me get this out of the way. Let me take this to 15. Yes. And in fact, it's probably, well, do we have more bricks there, Rickster? You have, yeah, let's see, from 9:30 to 10:30. Let's count the first hour. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 bricks, okay? How many do we have here? I'm going to have to count the first opening. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. And I'm only at 9:36. I'm going to give up. Yeah, quite a few more. I believe that it's easier to read because they're based on price movement and only on price movement, not on time. You don't, and it's on change, price change. Right in here, you get a lot of, I consider, noise. Now, what, heaven forbid, would happen is if I was on a 3-minute chart. Holy smokes. Well, the good part about, do I like a W bottom? Yes and no. I tend to like breakouts when you're talking about earning stocks and stuff like that, especially because Abercrombie & Fitch also had high short interest, which is why I was focusing on that one. Right, I was going to move to different time frames here. let's go here 1 second. Let's go to style, load style, today 5 minute. Oh, right. Okay. Yes, it does. I mean, and W pattern's not one of my go-to favorites, but guess what happens? The W turns out to be a breakout at the top of the W. And so therefore, the breakout slash zigzag pattern slash continuation pattern, they all work. It's all kind of one and the same for the breakouts. Here's a 5 minute chart. I like that. Where do I like to start? I'm a day trader, right? First part of the day, I like to be on a 1, 2, or 3 minute chart. Only at the first part of the day. Let me do the time frame. Why do I want to be at a 1 minute chart? Because I expect this to possibly move. And I can see down inside the candle. Now, am I going to trade less than 2 or 3 minutes? No. I'm going to let the market prove that it wants to go up. I will, ideally, I'd like to let it go for about 3 to 5 minutes. But if I see strong movement after 2 minutes, I'm not hesitant to go long at all. Remember, we went long at 24.44. So I was on the 1 minute chart and I watched it kind of bobble here. If I were on a 2 minute chart, what would these first 3 or 4 candles look like differently? Right here, we basically have a consolidation. It's trying to figure out whether it wants to go over 24.50. Well, let's go to a 2 minute chart. Time frame. Oops, I don't want to go to fractions of a minute. Well, that's kind of a high wave doji. So I know what's inside of it because we watched the 1 minute. I can get more detail at the beginning, but I'm very quick to move from a 1 minute to a 2 minute to a 4 minute, 3 minute to a 5. Because I'm trying to look and see what's inside the candle. When I'm using time-based charts, I need to drill down and then gradually increase as time goes through the day. Go from a 1 minute chart to a 2 minute chart and then to a 3 minute chart. That's why I've got the 3 minute. And I may stay on the 3 minute chart for 10 or 15 minutes and see what's going on. Then I really want to use most of the morning on a 5 minute chart. And that's where you see the move up and the pullback where we got to 24.60. Where we saw on the Renko chart where it pulled back to 24.60. Well, it pulled back to 24.60 here on the 5. And some people say, oh, it's just letting the moving averages catch up with you. Bull. What it's doing is it's absorbing all and kind of digest that big gap up. And then people are realizing it's not going to pull back. And since they're short, they're going to have to buy it at any point. They better cover right now. And if I want to do a trend trade during the day and multiple days, I may want to jump onto a 15 minute chart. At least I have that on the side. Now you notice what I have on my charts displayed, like the spiders. I will have a 5 minute chart. Sometimes I'll start off with a 1 day 5 or 1 day 3 that looks back at today and yesterday. Then I'll move to a 5 minute chart after, 10 or 15 minutes just so I can drill down and see what's going on. But I also have that 2 day 15 minute chart off to the left. I want to see the context of which we're moving. But I'm really only mainly interested in what we're doing over the last 2 or 3 days. Because that's where the buyers are going to and sellers are going to step up based on those swing levels. I'm looking for the swing levels. Well, let's look and see what we've got there. Aside. There's the 15 minute chart. There's the 5 minute chart. And I'm trying to figure out where are we going. I think if you go back and look and listen to the recording, when we were up here, we were flirting with this 278.50 or so, and we broke down. I said I wanted to wait for a bounce back up, and then I thought we would go back down to 277. We all should strive to get to the point where we can I should say this, predict or analyze where we think the price is going. How could I have done that? How did I know that it would want to go to that level? Well, one, we were stabilized yesterday for most of the day in this trading range, identified here that I put up. And then we opened up and then we started trading lower. What happened? Our moving averages started to go down. We went into a downtrend. And what else am I seeing up here? I know for a fact if we lose support levels like this 278.38, we're probably going to the next level. If we break above it, we're going to the next level up. Most of the time. Not all the time, but most of the time. And anytime I enter a trade, I am going to say, okay, what is it I'm going to see if I'm proven right? What will I see if I'm proven wrong on my thesis? Well, right is that it goes down, it bounces back up, it does a reversion to the mean. The mean can be either 8 or the 17 exponential, and then resumes its move lower. You can probably see it a lot better when we look at a 5-minute chart. Let's back off here. And there's the open. We went down to 278.38. We did a bounce. There's our reversion to the mean. And there's two places you can enter a trade. One could be very aggressive and enter as it goes down, say below, 278.50, with the stop somewhere up here where the volatility stop is. Or you could wait for the breakdown and still using the volatility stop. I'm not using that swing high as my stop. I don't care what tradition says that it's. To me, I don't have to let it get that high to be proven that if it went down here and broke down and it goes all the way, turns back up, sunshine, if it doesn't follow through, it's probably not going to follow through. I'll step aside, and if it then follows through, I either miss it or I jump on board later. All right, so where did it go to? It went to the 277 something that we looked at, or was it? The 277 eventually, but the breakdown went to 277.75. Did another bounce, another reversion to mean, and this was even better because it went to 278.30. And I think I remember talking about how we needed to watch this 278.40, 278 half level. We didn't get a change in the short-term trend. The 8 never got above the 17. Price got above it. Stochastic RSI got up there and said, watch out, watch out. We had an up move, doji, down move. 3 candles. Those are the only 3 candles I need to see. Come on, baby. Was it before that? It's right here. Bingo, bango, bongo. These are the candles that count. Not that one. 1, 2, and 3. Move up. Doji indecision. We got our decision. This could have been a continuation pattern. Unlikely with the stochastics the way it is, where the momentum is, and the fact that we came up to a resistance level. Yeah, right. Odds are that it was going to go down. Trading is about probabilities. That's all it is. And removing emotions. Extremely difficult to do. Okay, so we talked about the 1, how I use the 1, the 3, the 5, and the 15-minute charts. Well, while we're on the subject of Thinkorswim charts. Let's take our 10 Unarinco chart. Now, this is the beginning of the day. This is basically showing me that I'm in a solid uptrend. I do have one red candle down, but that's okay. It didn't penetrate even the volatility stop, did it? Where did it stop? Nope. Oh, excuse me, I had to clear my throat there. Okay, so what we're looking for here is a confluence of several factors here. Volatility stop, moving average, prior support level or resistance levels based upon hourly and daily charts. And oh, this little red line, that was a prior swing level. All of these came together in one fell swoop, and then we got to move back up. All right. And what happened? It went up as high as 25.20, and we were in the trade here, by the way. And then it came back. Where did it come back to? It came back to retest essentially the breakout level. The breakout level being 24.60. Wow. Then it went up to 25.40. Then it came all the way back to 25.60. We're in kind of, this is your W pattern I think you were talking about, right, Rickster? This is kind of the W. Let me see if I can look at here under width. Yeah. I'm going to say that that's your W. And there's the breakout. Okay. Cool. This is telling us we're in chop. Now, the range is from 24.60 to about 24.540. That's 80-cent range. Is that tradable range? Maybe. If that's what you want to go after and pull out. Is it possible or likely that after this did this move up here to the left, it did a pullback? What is that right there? Is that a J hook? Is that a zigzag? And is that your first target? With you being long here and your stop down here? Sure. Okay. I'll call it 25.70. And that right there is 25.20, or so 24.70. You're talking 50 cents. If you have 400 shares and you take off 200 at that first target, 50 cents times 200, that's $100. Even if you did 200 shares only, because you were a chicken like me. Okay, that right there, that's 50. Now what? Now you should take it into the trailing stop. Now, what are you going to use as your trailing stop? Some people use average true range, just the vol stop. Some people will use the 17 exponential. I tend to want to use somewhere around that vol stop. And you'd have been out with about another 40 or 50 cents. And with just 200 shares, you got just short of $100. You do that a couple of times a day, or 5 or 6 times a week. All right. Any questions on this before we move on? This is really talking about Thinkorswim. Okay, you talk about it the first one here, Rick, and thank you for the questions. I'm assuming that we're not talking about that move up. We're only talking about this. This is the move up, right? Okay, so that's where you go long, and there's your stop. That's the difference. That's how much you got at risk. You probably got about 20 to 25 cents at risk. So if you've got 25 cents at risk, and this move to there, to that move to there, is approximately just under 50 cents. That's kind of a 2 to 1. Now I'll take a 1.5 to 1 or whatever. But that's where I want to be. I want my stop underneath the swing low. Or if I'm a little on the late side, I'll take the average true range. I'll take the volatility stop. So if I didn't get into 24.90 because I didn't see it or I got chicken or whatever, then I'm not going to go all the way down here. I'm going to use the vol stop. It's tighter. And the reason is I do not need to let it go all the way back to 24.60 to be proven that I'm wrong. And so many people are stuck on, you got to be below the prior swing. No, you don't. You have to say, what does it take in your brain? What do I see on the chart, which will be transferred to my brain, that will prove to me that I'm wrong? What'll tell me I'm wrong is if price starts going the wrong direction. Now, what else is happening here? Stochastics RSI is coming up from the bottom. I mean, so many people they're hung up on these rules that don't really make any sense. Why should it make sense that where did Moses bring down on tablets that you had to be below the prior swing? No, you just have to be below something that proves me that my thesis is wrong. That's just so frustrating. And then if you want to play over here to the right, obviously the breakout. And it took a while. It took from 10:05 to about 10:30, 10:25 for that to finally prove that it wanted to try to break out. And that's when I was talking about Abercrombie and all of this, saying, boy, this is a grind. It's a mess. I didn't want to be in it. And I stepped aside. And then by that time, I'm out towards lunch. And it ground higher. But this is not what I wanted to play. Now, let's take ourselves into a different time frame. What if I did 5 ticks? Let me take ourselves back early in the day. There's the beginning of the day. Does this look like a mess to you? Until we get the breakout, and then what happens? It's still jaggedy. 10:20, 10:20, 12:50, 1 o'clock. Then we get a trend down. I'm sorry. Let's go up to, say, a 15. Good Lord, here we go. Time frame. Okay. If you give yourself 15 ticks, you finally got it. The noise gone. Excuse me, folks. I need to step aside for 1 second. I got a problem I got to deal with. Okay, thanks, folks. I'm back. Hey, Young. Glad to see you could finally come back. We are recording this, and it's perfect timing for us to actually talk about what we see in the regular charts. Right now, do we have any questions that we've covered all of the patterns? We've covered all the different philosophies, and you've seen how you can, excuse me, how we can eliminate noise by using the Renko charts. But the problem with a Renko chart, that they're not all just one. Hi, Cindy, how you doing? That could be one thing. I'm still the verdict is kind of still out. I've only been trading stocks using the Renko charts for about solidly for about 9 months. So I traded for a couple years on the futures, and there were only 4 of them. But what I'm starting to come to a realization is, for me, is that if I'm trading stocks and they're good momentum stocks and whatever, an 8 to 10 ticks usually works. That we're talking about, I like to trade earning stocks or stocks that are on big momentum. So an 8 to 10 ticks works. It gives me movement. It doesn't get too much noise. It doesn't do too much zigzags or whatever. Now, with the ETFs, the leverage ETFs, it's going to be more like 2 or 3 on the tick charts. And the Renko charts and Thinkorswim are a little bit different than NinjaTrader. They're within about 1, but they might be a little bit different. But 8 to 10 works for individual stocks. 3, 4, something like that works for leverage ETFs and, say, like the Spiders Qs directly. But you'll have to play around with it. But that does, that's what I expected. I don't understand what you seem. It seems dull. If you were talking about the last one, I'm not sure when you showed up, but the Abercrombie and Fitch, that's slow. Now, if you want, I'm going to be a little bit of a smartass here. If you want excitement, I can show you excitement, but my idea is here is to make money. That excites me. So the whole idea is that, see, right now we're on what kind of tick? We're on 15. Let's take it to, well, let me show you that. I think it's somewhere between 8 and 10. Let's try 8. I'll try earlier in the day. Now, maybe Abercrombie and Fitch is not a good one to show. Maybe Dollar Tree Urban or something like that would be a better one, because this one had spurts of activity. And yes, the dullness might come from the fact that it's that individual stock. What happens if we went to, say, something like Dollar Tree? Now you're starting to see some movement. Now that's early in the morning. And this is with 8. Let's go to a 10. All right. It was pretty dull to start with, but then you got yourself a pretty good movement here, and a pullback, and another good movement. This is a perfect zigzag. Came back to about 97.50, which is kind of where we had this prior. So when you talk about dull, I think you're talking, I'm going to assume that you're talking about lack of price movement. That could have just been Abercrombie and Fitch. And if you don't see it on this, well, heck, why don't you bring up a time-based chart as well and put it on the side? Let me see if I've got one here. Okay, hold on. And I do have them side, yeah, okay. And you're absolutely right. Well, I only traded a minute and a half on Abercrombie and Fitch this morning because I didn't see the fact that it was going to have a good reward to risk ratio for me. If I had backed out and put A and F on, say, a 15-minute chart, see how the 5 is, it's grinding higher, but these are wide swings. I just didn't want to give them. What happens if I went to a, oops, that's a 5-minute, 2-day 15? Well, I got price movement. To me, the reward to risk ratio may or may not be there. Maybe it's just the wrong stock. Wonder if Dollar Tree would look any better. And that's why we have to bounce around from one to the other at the morning. And sometimes we get the right ones and sometimes we miss the good ones. Dollar Tree had trouble at the beginning of the day. And it took really until about 11 o'clock. And then it started to take off. Dollar Tree. Well, you did get on Ringo, this movement over here to the left at about 9:45. 9:45, this was tradable. 96.75 to 97.75, it's a buck. Now, I'm predicating this all on my ability to recognize things, and number 2, the fact that I have extremely low commissions. I could buy 50 or 100 shares of this and make money because I use interactive brokers and only have to pay somewhere around $1 round trip, sometimes $2 round trip for upwards of 200 and 400 shares. If you don't have extremely low commissions, you probably should not be day trading. You should swing trade, maybe intraday, using 15, 30, 60-minute charts, or go to swing trades. You must have low commissions or you will get absolutely smoked. Or you'll have to use cheaper stocks where you can buy a gazillion shares, 1,000 or so, and spreads that commission over more shares. That's my opinion. Now, I'm assuming that everybody is going to have more than $25,000 in their account, be it an individual retirement account or not, so that you can avoid the pattern day trader exclusion period. Okay, now let's go here, and I'm going to explain, and then feel free. I'm not sure if you were able to read that before you had to leave earlier. Feel free, anyone has questions during the trading day. At any time, you have a question in the general chat so everybody can see it and so I can answer it for everyone to share. Put it out there. If I can't get to it, I'll probably say, I can't get to it right now. Let me get to it in a minute. But I will recognize you and talk to you about it. If I don't, I've not seen it, so you need to post it again. And at the first available opportunity, I will answer your question. All right. Now, what do I see here? I usually keep the spider. No, I always keep the spiders 15 minutes in the upper left-hand corner. And this is a 15-minute chart with my stochastics RSI Wilder 7733. That's my go-to chart. And where I will do is I will mark up based on dailies, hourlies, and 15-minute chart swing levels. Well, two things happened yesterday. I put up this channel. We could make that channel right like that or whatever we wanted to do. And I drew it as not level. And that's fine. And then I said somewhere at the bottom, over here, I'm going to watch a breakout at the top or a breakdown on the bottom. And it took, towards the end of the day, we started pushing it, and the open today is when we really push lower. So I'm looking at that and I'm saying, okay, this is my overall direction. This is what I'm looking for, and I want to trade in the direction of the trend mostly. Now, things like Dollar Tree, Abercrombie and Fitch, Brown-Forman, Urban Outfitters, anything that was on its own page, those their own news. They're trading in their own space. So if I'm going to trade, the markets and the general markets, I want to be in the direction of the trend. All right, and I'm going to compare the 5-minute chart here versus there, and you're going to get commentary from me today during the day. I'm going to have a 5-minute and a 15-minute on the spiders up all the time, and the VIX. The VXXB will be here 100% of the time. Now, do we trade the VXB? We probably only traded it a couple of times. It gets to be a bit. It gets to be a bit ragged, and to me, there are going to be better opportunities to make money. But some people want to see the VIX. I could put the VIX up. I could put the VIXB up. It really doesn't matter to me. I could even put up tick chart if people wanted that. So this one is just trying to look at volatility. On the lower left-hand corner, what I normally put up is on the left would be a daily chart, and of the same symbol, I'll have a 5-minute chart. So when I have my watch list here that I'm looking at off to the side, I have it over here on the left-hand side, and I'll just click on Spotify. And you can see how I was watching it because it was breaking over 140. This one's on its own page, and I'm looking at Stochastics RSI. And on a swing basis, it looks pretty good. Intraday, not necessarily so. Target. This is a follow-through from yesterday's earnings. And where is it going to? It's going to the pre-market highs. C-Trip. Trying to do a 45-degree runner. And then I'd just step over to Facebook. I had Foot Locker on my list, but that's not going to work. Wyndham Hotels was looking pretty good, and then it's basically crapped out. The markets are dragging it down. J&J. So most of these things are not working. They're not working at all. Medtronic, I went long yesterday, and the market is just dragging it lower. Now, it's fighting it. We did drop from about 92 something, and you can see all these. I'm going to go over LTA in just a second. See how this 2-day low and the 5-minute low are just zinging along? That tells me that we're getting selling pressure big time. Zing, zing, zing. This is the S&P 500, and this is my trading universe. And we're getting no new highs really on the left side here, and not even new 5-minute highs. Now, I'm going to do an analysis right here real quick. They're going to try to hold us at 277 again. We're doing what some people call a dreaded H. We may dip our toe and nose on the other side of 277. And we'll do one of either two things. We'll either follow through, or they're going to rip them off. And what you would want to do normally is when this is up here and we lost 277.50, go short there, and then your 277 is your checkpoint. Not wait for the breakout. Because wait for the breakout, it goes over here. If it fails, you're going to end up losing. If it goes up here and you got it go short and it fails to break out, you've only got a half winner instead of a full winner. All right, so this right here is where you're going to see what I'm looking at when I am trading something. I'll bring up my Ninja Trader chart because I'm trading off of that one. Interactive brokers. All right, 932, 933. We're looking at, we were long 24.44. So we were long from dirty blog. All right, we were along from there. Whoa, wait a minute. There's a continuation pattern. There's another continuation pattern. Amazing. These things work. Let's point them out. There's one. There's two. There's three. That was a no-no. It didn't work. Because the third candle. Where's the sell point? Probably right there. $24.95. Where did I get out my last one? $24.94. That's what I traded this morning. I am looking at a Unirinco chart. It's a type of Rinco chart. I'd be happy to share with you if you do have NinjaTrader. It's set at 8 ticks with 12 tick reversal. And that's my standard go-to, and a Unirinco chart for stocks that are, is there equivalent in toss? Okay, there is and there isn't. I want to make sure I cover the LTA. I'll come back to that in a minute. All right. Because they don't have Unirinco. All right, 1 second there, Sid. A and F. Okay. This is a 10. Let me go ahead and set it to 8, and I'll show you the differences there. Whoops. Let's pull them side by side. And let's pull them up at the first part of the day. Oops, I didn't mean to do that. I meant to pull it over. All right. This is an 8 Rinco chart. What you do here is you go to Style, Time Frame Setup, Time Frame, Range. I use today, so that I only look at today's trading. And I do a pull down issue. You could use a 10 tick. If you want to use something that's not 5, 10, or 15, you blank that out. You put the number you want in. You hit the tab, so you have the ticks. If I do it before hitting the tab, it shows 8 and it doesn't remember my changes. So I have to make sure it's 8 ticks and hit OK, and it will then change it to 8 ticks. And that's how you get a Rinco chart. It's type of range chart. Let's try this from scratch. I'm on a 5-minute chart. I want to go to Style, Time Frame Setup, Time Frame, Range. Let's do today. Let's do 10. Okay. It's the same as setting it up. Now, why is this different than this over here? It's because there's one more change that has to be done. All right, the range type has to be changed from range bars to Rinco bars. And then what I do is I save the style, save style. And when you do that, make sure you have the box here included. I'm going to hit cancel because I don't want that to overwrite the 5 minute. Okay. City, could you have the indicators for this trader 8? Da, da, da. Okay, City, could you send me a private message? Hey, no problem. And if you have trouble or you whatever, ask, and then we can help you out as well. Sid, could you send me an email request? Whoops. Well, why is this working? All right, the Top Gun Trading 2 at gmail.com. That's Trading 2. Somebody got Top Gun Trading and they haven't used it in 6 years, and I can't get them to respond to me, and I can't get Gmail to kill their email and give it to me. Anyway, so that's where we are. And then I'll forward it to you. I'll be using a thing called WeTransfer, and it will because I cannot email executables to you. You won't be able to do it. So you'll get an email from that said that Steve's trying to send some files to you. All right, folks, let's see if we've got anything more here. Well, any questions? We've been a little bit in the questions. I really appreciate having the interaction with you today. I love to try to help, and I love it when I like making presentations, but I really enjoy trying to answer the questions and help people. All right, I will point out again, we have the slides today. There's the ebook that I've got out there for everybody. And bye, Rixer. You're welcome. And what's the other? 2019. It's listed as 05, but in fact, we know that it's 06. All right, without any other further questions, I'm going to put the stop the recording. This will go up.